So first and foremost, a very, very warm welcome to all of you in today's session, which is another webinar as part of our webinar series, deep dives with IIQF experts. And in this webinars, we discuss about important topics concerning our industry of financial engineering, risk management, quantitative finance, ML data science applications in finance, algorithmic trading, and all of that, right? And today's session is also very important. It's a very important topic actually, right? The machine learning versus traditional models in market risk. We all have been hearing about uh, how machine learning, data science, AI has penetrated every field, particularly our field of quantitative finance, risk management, algorithmic trading, and all of that. But there's a lot of debate still going on. In terms of efficacy, effectiveness, in terms of regulatory areas, in terms of like again explainability and all of that, right? So we would in today's topic we will be understanding about the comparison or the work of like both machine learning as well as the traditional models, particularly in market risk today. And to talk on this topic, we have, or rather, we are very glad to have with us Ritesh Chandra. Ritesh, thanks so much for joining in. As always, a great pleasure to have you with us.
Yeah, hi Nitish. Good morning and good morning to all of you. Thank you for inviting me.
Right. Thanks for joining. And just to give a brief intro about Ritesh. Ritesh has done his master's, the MBA from IIM Calcutta. He is a BTech from IIT Kanpur. He has also done his CFA. Has also earned the sustainability and climate risk certification from GAR. And he has a diverse industry experience, including leadership roles at Yes Bank, RBL Bank, Barclays, where he successfully managed large credit portfolios and teams. So Ritesh is an accomplished trainer as well, an educator with more than 2,000 plus hours of training sessions delivered over the past 10 decade. And with more than 15 years of experience as a banker specializing in credit risk, trade finance, project finance, he brings a wealth of practical insights and hands-on experience to his training programs. He is a member of IMT Center of Distance Learning and Distance Learning Ghaziabad Board of Studies. Presently, Ritesh works as a freelance trainer, educator with various organizations, including our Institute, Indian Institute of Quantitative Finance. Also, he teaches for College of Supervisors, RBI, Emeritus. He's a program leader there for in AIML, Crisis Academy, where he trains for credit risk, great learning, where he teaches on digital banking and finance, and for many other educational institutes. And Ritesh is a great enthusiast of the machine learning field as well. He's doing a lot of work in that also, right? So yeah, he is a wonderful person to speak about this amalgamation of the banking risk and machine learning, right? So I'll hand over the session to Ritesh, but before that, very quick run through on how we would go about in this session, right? So, as you all know, we would be having a talk on this topic of the day for about an hour, and followed by a question and answer session. So please feel free to keep the questions flowing. Uh, there's a Q&A section. You can type in your questions, doubts, queries, anything you want to discuss. We want the session to be very interactive, but unfortunately, since the participation is quite big, there's a lot of participants, so we would not be able to allow you to speak up. But nonetheless, you can always put up your questions in the chat window, and we would be taking all the questions one by one in the Q&A session. So with that, I'll hand over the session to Ritesh. Ritesh, just let me make you the presenter. Yes, so I've made you the presenter. Whenever you are ready, please feel free to start.
Yeah, can you see my screen?
Yeah, absolutely. Absolutely.
Okay, hi. Good morning, everyone. And once again, thank you for joining this session. So as the session says that we would be talking about how machine learning or ML models stack up vis-a-vis the traditional models. By traditional models, I mean the value at risk models and the stress testing models that we have in general been using for market risk modeling or market risk measurement. Now, first of all, this is no longer a theoretical debate whether we should prefer operational machine learning models or whether we should stick with the traditional VAR models. Of course, regulators still prefer the VAR and the expected shortfall. And under the new regulations, which is the Fundamental Review of the Trading Book or FRTB, expected shortfall has become more prominent. At the same time, when you look at some of the ML models like random forests or LSTM or XGBoost, they clearly demonstrate a superior ability to map market risk, which has the features such as non-linearity, fat tails. They seem to be better at that. At the same time, uh, outperformance or superior performance is something which cannot be considered on only one metric or only one dimensional. It is a multi-dimensional metric. So of course, ML models, they appear to be better in terms of predictive precision. But if you look at the traditional models, they still have a significant lead or advantage in terms of the transparency that the regulator wants or the structural stability that these models provide. So these are some of the things that I would want to talk about in today's session. So let's first take an overview of what we have been doing traditionally. So as all of you would know, value at risk or VAR is the industry standard metric when it comes to quantifying the risk of financial loss within any firm or any portfolio over a specific time frame. So this is the basic model that you use for financial loss modeling. The question it answers is, what is the maximum loss that I can expect to suffer over a given time frame and with a given confidence level? So if I tell you that my 1 day 99% VAR is $10 million, it means that there is a 1%, there's only a 1% chance that the portfolio will lose more than $10 million in a single day, assuming normal market conditions. Or the other way to look at that is that 99 out of 100 days, the maximum loss that I may suffer due to adverse movement in the market over a 1 day time horizon will not exceed $10 million. Now, traditionally, we have had three different methodologies to calculate this VAR. So you have the historical simulation of what you call the non-parametric approach, where you assume that the future will be a reflection of the past. So you simply look at the actual historical returns of the portfolio assets in the past and you apply it to your current portfolio and you kind of try to estimate how the P&L might look like in the future. So if you have to calculate, say, a 100-day VAR, you will look at the last 100 days of market moves. And in that last 100 days of market moves, if the second worst daily return was, say, a 4% loss, then you would say that my 98% VAR is 4%. That's how you work with historical simulation. Problem with historical simulation is it's entirely backward looking. It simply cannot account for anything that hasn't happened in your look back window. And it also suffers from what you call the ghost effect. So if a massive market disruption or a massive market crash happened, say, 251 days ago, and your look back window is, say, 250 days, then the VAR will suddenly drop tomorrow. not because the market regime has changed, but simply because that large market drop event has moved out of your look back window. So that ghost effect is a major issue with historical simulation approach. Then you have the parametric, or what you call the variance covariance approach, which is, I think, the most preferred in financial institutions a lot of times. Here you assume that the market return is coming from some specific statistical distribution, typically the normal or the Gaussian distribution, and you calculate risk using the mean, using the standard deviation, and using the correlation of assets. The major issue here is that because you have assumed a normal distribution, it does not account for leptokurtosis, or what you call fat tail return distributions. So in finance, if you look at the way things actually happen in the real world, you will find that extreme events happen much more regularly than what a normal distribution would assume or predict. For example, if you look at the 1987 Black Monday crash in US, it was supposed to be a 20 standard deviation event. And if you take a Gaussian distribution under the parametric approach, the probability of that event is so remote that it should not happen over the entire course of the universe, over the entire lifetime of the universe. You should not be witnessing a 20 standard deviation event, yet that event happened. So that is a major issue with the variance covariance or the parametric approach. And then you have the simulation, or specifically the Monte Carlo simulation. This is the most, I would say, computationally intensive approach. So here you use random sampling to generate hundreds of thousands of paths that asset prices can take. So you assume some stochastic process that is generating the asset price. Typically, it would be a GBM or a geometric Brownian motion. So what you will do there, you will define the mathematical model that you want your asset price to follow. You will generate, say, 100,000 or 1 million different random price paths based on that model. You will calculate the portfolio value at the end of each path, and then you will sort all these outcomes, and you will create a probability distribution, and you will calculate the percentile, which kind of conforms to your confidence level. So that is what you do in Monte Carlo simulation. But again, that is computationally very intensive, even with the advent of modern computers and processing capabilities. So that is about the VAR models as such. Then comes what you call stress testing. Now, why do we need stress testing? See, VAR is telling you a probabilistic estimate of what are the losses that you can incur under normal market conditions. As I told you, if my one day 99% VAR is $10 million, then it's like saying that 99% chance is there that your loss will not exceed $10 million, or there is a 1% chance that the $10 million VAR threshold will be breached. So it's a probabilistic exercise. Stress testing, on the other hand, is a more deterministic exercise. The purpose is to evaluate how your model would perform, or how your portfolio, rather not your model, how the portfolio will perform under different scenarios. And these scenarios are extreme scenarios because you are doing stress testing. But these are plausible scenarios. They are not out of the blue. It is a complement to the VAR because it captures the risks which are sitting in the extreme tails of the distribution. See, one of the major limitations of VAR is it tells you that 99 out of 100 days, this is what your maximum loss is going to look like. But on those 1% of the days when the VAR threshold is breached, it is completely silent on what would happen to you. Okay, so that is what we are trying to figure out using stress test of what happens in the tail of the risk distribution or the return distribution. So unlike VAR, which is asking how much I can lose over one day with a 99% confidence level, that is the question that you ask for VAR. In stress testing, the question you are asking is, if scenario X happens, then what would I lose? The approach here is that you manually or systematically, you have to adjust the risk factors, whether they are interest rates, exchange rates, equity prices, or volatilities, to see what is the impact on the portfolio's net asset value. So it's a fundamentally different question that you are asking. Here you are creating scenarios and trying to figure out that if that particular scenario happens, what will happen to your portfolio as a financial institution. Of course, you have different types of stress testing scenarios. So the simplest is what you call the historical scenario, where you simply replay the crisis which has happened in the past and what happened to the different market variables when that crisis actually occurred, and you superimpose that on today's portfolio. So it's like asking the question that what would happen to my current portfolio if the 2008 Lehman Brothers collapse happens tomorrow. That is a stress testing based on historical scenario. Or you can have a hypothetical or what you call a prospective scenario, where the expert will design some kind of an event based on current geopolitical or economic vulnerability. This is how typically you would do it in the real world, where the what if scenario will be given to you by the regulator, which would be the RBI in Indian scenario. It could be the European Central Bank in the European Banking Authority in case of Europe, the Fed in the case of US. Here you would get scenarios like, suppose there is a sudden 100 or 200 basis point jump in interest rates combined with a 20% drop in all tech stocks because there is a sudden global chip shortage or some geopolitical event has crystallized. So this is what we have been doing traditionally. So you have the VAR, and as a complement to the VAR, to understand as to what can happen in the tail, you have stress testing, which is primarily driven by scenario analysis. Now, the fundamental flaw of the VAR model is, I would say, two things: regime blindness and correlation convergence. Now, what do I mean by that? See, these VAR models or the traditional models, they make some very specific assumptions about how the assets interact with each other. Because when you are looking at a portfolio level risk, it's not enough to understand how the standalone return plays out. You also have to understand how the different returns interact with each other. Now, traditional models, including the parametric VAR, they depend on a mathematical structure which is called the correlation matrix or the variance covariance matrix. The correlation matrix or the variance covariance matrix essentially tells you how different assets in your portfolio move vis-a-vis each other. Now, the first problem with the traditional model is they assume that the correlations are stationary or stable. So for example, when the markets are normal, it will tell you that gold can act as a hedge for stocks because historically it has shown a negative correlation with equity prices. But this holds true only during a normal market, or what you call a quiet period. During a systemic crisis or a financial contagion, investors will face what you call margin calls, and they will be forced to sell everything to raise cash. Now, because everyone is selling everything simultaneously, the correlation between asset classes, whether it is gold, stocks, and bonds, which were very low during the normal market period, suddenly everything will start moving towards a correlation of 1. And how does it impact you as a portfolio manager or as a financial analyst? See, because traditional models work with correlations, historical correlations, I would say, they always teach you that it is better to diversify and have a diversified portfolio for better risk management. But actually, that is what we call a diversification trap. It gives you a false sense of security. And why do I say that? Suppose you have a model which has worked with 3 years of data during the normal market period. That model will suggest you that if you have a portfolio which is, say, split between US equities, emerging market bonds, and gold, that portfolio is very, very safe because historical correlation has been low or even negative. But when the financial contagion will hit the market, this entire logic of low correlation historically will go for a toss, because now you will have things, or you will have drivers which will cause all the correlations converge to 1. The first thing which happens is you have a liquidity spiral. So when stock prices, when equity markets crash, all the funds which are leveraged, or all the investors who have invested using margin money, they will face margin calls. And to cover these calls, they are not only going to sell the stock portfolio, which is falling anyways, they will also sell the assets which have been winners in the past, like gold, or their liquid assets like bonds, to raise immediate cash. A good example of that would be what happened in the 2020 COVID crisis, when gold, which was traditionally considered a safe haven vis-a-vis equity market crashes, it fell alongside all the benchmark equity indexes. And why it happened? Because investors needed to liquidate their gold holdings to cover margin calls in the equity market. Now, if you had a traditional VAR model, that would only look at the historical negative correlation, and it would predict that when markets crash, when equity markets crash, gold would either rise or gold would stay flat, and it would severely underestimate your actual portfolio losses. So liquidity has a big role to play when the entire correlation structure breaks down compared to what you have assumed. And because the traditional VAR models only look at historical averages, they simply cannot see the structural breakdown of these relationships and when they would happen. The real world impact of this is that as a financial institution or as a fund manager, you will be chronically undercapitalized, because model will tell you that the different assets by virtue of diversification will offset each other during a period of market crisis, but in a real crash, all the assets will bleed simultaneously. So the firm's actual loss will end up being a 10 standard dev event relative to a model, a VAR model, which was only prepared for a normal 99% VAR event. Okay, so this is one of the, I would say, the fundamental problem with the VAR models. Now let's talk about how some of the machine learning models chip in. So first of all, what is the difference in approach? So unlike the traditional patterns which require explicit statistical distributions and programming, the ML model is a pure data-driven approach where it is trying to learn patterns, and they are widely used for volatility forecasting, for credit risk scoring, for fraud detection, and of course for VAR calculations. Key techniques here would be supervised learning techniques like random forest and gradient boosting, which people have used or they have been using to predict net charge-offs in a credit portfolio, or the pre-provision net revenue, what you call the PPNR, when you do a stress testing of a bank. Similarly, you have the neural networks or the deep learning models, LSTMs, transformers, which are used for time series analysis, for capturing volatility clustering in particular, to capture the tail risk. Then, of course, you have the Gen AI models, the generative models, where you use techniques like GAN or generative adversarial network for simulating financial time series in order to improve your VAR and expected shortfall calculation. And these days, you also have hybrid models like GARCH LSTM or VMD ANN LSTM GRU for predicting volatility. Now, the key question. These ML models, how do they look like in terms of accuracy vis-a-vis the traditional VAR models? You see, the basic advantage, the fundamental advantage of the ML model is that it does not view the market through the lens of a fixed distribution. Rather, it looks at market risk as a high dimensional pattern matching activity or a pattern matching problem. Because the approach is so fundamentally different, it is much better suited to capture complex non-linearity. What I mean by that is, if you look at the traditional VAR models, they will typically assume that if asset A and asset B have a correlation of say 0.5, then that correlation will remain constant through time. On the other hand, if you look at ML models, say a gradient boosted tree, XGBoost, that can actually identify conditional dependencies. What I mean by that is, the machine learning model will tell you that, look, asset A and asset B are practically uncorrelated during periods of low market volatility, but they become 90% correlated if the VIX or the volatility index exceeds or crosses a certain threshold. This ability to model conditional tail dependence, I would say, is the single greatest advantage that ML models have over the traditional VAR models. That is one aspect, capturing complex nonlinearity. Then you also have to understand the dimensionality of data aspect. Traditional models, again, they are limited or they are constrained by what you call the curse of dimensionality. What I mean here is, if you add too many variables, the model becomes unstable. Machine learning models, on the other hand, sorry for that. So I told you the first advantage was that they are able to capture complex nonlinearity, or what you call the ability to model the conditional tail dependence. The second major advantage is, unlike traditional models, which cannot handle too many variables, they become unstable. With high dimensional data, the machine learning model has been designed to work with high dimensional data. So by high dimensional data, I mean you can have natural language processing driven sentiment analysis as part of your VAR model, or as part of your uh, financial loss modeling exercise, where you can do real-time analysis of the central bank speeches or what is coming in the news feed. You can bring in things like liquidity indicators. What is the imbalance in the order book? What is the bid-ask spread dynamics? And you can also bring in macro correlations. So uh, you see, if sometimes you have subtle shifts in the yield curve or in the commodity prices. Yeah, yeah. Kindly, can you switch off your mic? Yeah. Okay. And you can also bring in macro correlation. So what I was saying is that sometimes you have these subtle shifts in the yield curve or the commodity prices, and it will take typically weeks or several days for that to reflect in the traditional VAR report. Whereas if you look at a machine learning technique, say a long short-term memory or LSTM networks, they are very, very apt here because they can remember long-term historical cycles, and at the same time they can forget irrelevant short-term noise. So again, the moral of the story is that using the machine learning models, you can bring in higher dimensional data as part of your risk modeling exercise. The third advantage, in my opinion, is using the variational autoencoders, or the VAE, and the GAN, or the generative adversarial networks, which are essentially machine learning or artificial intelligence techniques. You can do what we call dynamic scenario generation. Now, what do I mean by that, and how does it compare with traditional stress testing? In traditional stress testing, we create these manual what if scenarios. What if 1987 happens again? What if 2008 happens again? But the ML driven approach like using GAN and using the variational autoencoder, that takes a fundamentally different route. What is happening in the ML approach is you are learning the underlying manifold of market reality, and you can generate thousands of synthetic but statistically plausible nightmare scenarios that a human risk manager might never even conceive or think about, such as a simultaneous crash in tech stocks combined with a spike in oil prices combined with a liquidity freeze in the repo market. So using Gen AI, you can create thousands of such scenarios, which are all bad scenarios, but they are all statistically plausible. So these are the three major advantages of the ML model, which gives it a much superior ability to predict the loss vis-a-vis traditional VAR models. Let me just talk about how the two compare. So which is the winner? First of all, you have to define what do you mean by the winner, and that is a nuance. So the choice of the algorithm which is better will depend on who is the audience. If you are optimizing for the trading desk, accuracy will be more important. But if your audience or consumer of the report is the compliance department or the regulator, then of course stability and how much you can explain the model or how much you can interpret the results, that becomes the dominant factor. So I've just highlighted some of these. You can see when it comes to quantile loss or accuracy compared to traditional VAR models, the ensemble machine learning techniques or deep learning algorithms, they're a straight away a winner. When it comes to capturing tail risk, again, machine learning models are found to be superior because they are able to identify the non-linearities. When it comes to explainability, now the situation is different. The traditional VAR or the expected shortfall model is much superior because you can explain it to the regulator. Whereas for some of these deep learning or neural network models, explainability can be quite low. So here the traditional model is the winner. In terms of regulatory standing, again, traditional VAR ES models dominate because that is the regulatory standard. You have to be compliant with the FRTB regulations. ML models are more in the nature of experimental models. I mean, they have a challenger model status, but they are not what the regulator will actually accept. And finally, in terms of regime adaptability, how good your model or how resilient your model is when the market regime changes, again, ML models are a clear winner because here you have automated feature learning, whereas when it comes to a traditional VAR model, you have to manually calibrate or recalibrate for the change in market regime. Okay. The key issue with ML model is with regard to model risk management. So the primary reason, so someone may ask that if ML models are so better in terms of accuracy, why haven't they replaced the VAR model? Well, the primary reason for that is not lack of performance. The primary reason is that model risk management has very rigorous demands, which sometimes the machine learning technique cannot fulfill or cannot meet. Two things: the interpretability gap and overfitting. Now, what do you mean by the interpretability gap? So if you look at some of the regulations like the SR 11.7 regulation in the US or the BCBS 239 global regulation, a bank is obligated to deconstruct a model's output. That means if someone asks you to deconstruct the model's output, you should be able to do it. Let me give you an example. If the ML model says that or predicts a massive loss, then the risk committee will ask, what is driving this massive loss? Is this because of interest rate sensitivity, say delta, or is it because of volatility, which is vega? Now, a deep neural network cannot answer these questions naturally. And the regulator tells you that if you are not able to deconstruct the model outcome, if you do not have the conceptual soundness in terms of what is driving my model outcome, then sorry, the model cannot be used to determine your capital requirement. So that is one aspect. The second aspect is overfitting and spurious correlations. So ML models are exceptionally good at finding patterns even when they don't exist. A very famous example is the 2010 flash crash in US, where many of the automated models, they made the sell-off much more severe because they reacted to some patterns in the high frequency data, which was essentially noise. Traditional models, on the other hand, because structurally they are much more simple, they are much less likely to hallucinate when encountered with noise. So that is the two key problems I would say we have to deal with when it comes to using machine learning models. So finally, what is happening in the industry today? We are probably moving towards what you call a hybrid framework, or the emergence of a Quant-ML. In this hybrid framework, you will combine the intuition of the financial physics, which is the traditional model, with the power of data science, which is machine learning. And in this hybrid framework approach, you will essentially have three things. So you will have an explainability layer where you will use technique like SHAP, the Shapley additive explanation, or a technique like LIME to translate the black box activation of a neural network into Greeks, delta, gamma, vega, that you can explain to the world. So this will allow the risk managers to see exactly which market factor is driving the risk estimate. That is one aspect of the hybrid framework. The other aspect is ML will continue as the challenger model. So what I mean by that is that financial institutions will keep their traditional VAR model for regulatory reporting purpose, and simultaneously they will run a machine learning based VAR model in parallel. If the ML model will show a significantly higher risk compared to the traditional VAR model, then you can use it like a early warning system for a potential shift in market regime. And the third aspect of this hybrid framework would be what you call hybrid modeling, where you will use hybrids like GARCH RNN, where GARCH, which is a traditional econometric method, will be used to handle the baseline volatility. And on top of that, you will have a RNN, or a recurrent neural network, which will be used to model the residual, or the parts of the market that the traditional maths is not able to deal with. So to just summarize this entire session, uh, machine learning models significantly outperform traditional models in terms of forecasting accuracy, in terms of crisis detection. But the traditional models still remain superior as a institutional mechanism or institutional guardrail. And in my opinion, the future of market risk is not that the human risk manager will be completely replaced by an algorithm. Rather, it will be the enhancement of the risk manager's ability to look at things in terms of the higher dimensional machine learning driven insights that he will be able to generate. And of course, all this has to be backed by a robust model risk management framework. So that's pretty much all from all what I wanted to talk about. Any questions, I'll be happy to take.
All right, wonderful. Thank you. So yeah, to all, I mean, please feel free to type in and ask your questions. But before that, maybe to give Ritesh a little bit of breather as well, and maybe to quickly uh, talk about the things that we have been doing at IIQF, right? So very briefly, allow us to uh, maybe yeah talk about like quickly again what we do, what we offer, and how we can help for those who are interested in learning, making a career in the field of machine learning, data science. All right, so just like again very quick on that. Okay, so though most of just a minute. Oh, I don't know why this is happening. All right, sorry for that. Okay, so most of you know, but very quick introduction. I represent Indian Institute of Quantitative Finance, and we are a body which have been promoting this field of quantitative finance and financial engineering related areas, particularly in the education space, for more than 1.5 decades. So we are one of the pioneering body in quant finance in India, and we have specialized in education and training in the field of quantitative finance, financial engineering, risk management, quantitative algorithmic trading, uh, artificial intelligence, and machine learning applications in finance. We have been founded by leaders from the quant industry, people who have done pioneering work in financial risk management, financial engineering, investment banking, and related areas, right? So for those who have an interest in learning about this field of financial engineering or quant finance in general, or maybe specifically in algorithmic trading or machine learning data science applications in finance, and those who are specifically looking to upskill themselves and like make a career in this field, or even if you are working in a particular field already and you want to go deeper. So we have multiple courses which are pretty long duration, comprehensive, and these are done on a weekend online live lecture basis, so you can do this along with your job or along with any other full-time degree that you are pursuing, right? So just a quick glance on the courses that we offer. But first on the domain side of financial engineering and quantitative finance, we have a course called certificate program in financial engineering, which is like again a program of like 8 months. My apologies, mentioned 7 months here. So it's in the 8 months weekend program. And then we have a course called quantitative finance and risk management. These are both courses which teaches the quant and risk management in detail. Financial engineering is like a course which goes into very heavy mathematical modeling and uh, mathematics and mathematical modeling, uh, particularly suitable for people who are from quant backgrounds, engineers or mathematics statistics people. But the quantitative finance and risk management is a very deep course in itself, but the teaching methodology is a little less mathematical and the focus is more on the risk management side. So that's like a program which can be done even by people who are like from pure finance, apart from the quant background people, if they have an interest in like working in this field, right? And those who are interested in particularly making a career in the field of algorithmic trading, um, we do have a course which comprehensively teaches how to build algo trading systems using different kinds of strategies, starting with pure finance strategies like technical analysis and price action strategies to going into machine learning and quant model based strategies. So pretty much giving you a total framework on how to do systematic trading and how to build algo trading systems using different kinds of strategies. Uh, and as I mentioned, so basically, like again, for those who have a particular interest in understanding the field of AI. Now in finance, AI is generally a combination of data science and machine learning, because the other part of AI, the robotics, is generally not like that much required in finance. So when you talk about AI in finance, it is pretty much about machine learning and data science and their applications in finance. So we have a very comprehensive course called Artificial Intelligence for Finance, which teaches the entire field of data science, machine learning, and their applications in finance. So it has three parts. Actually, the course is divided into three parts. The first 3 months teaches you the data science areas in finance, so data analytics, data visualization using Power BI, Tableau, I mean, data modeling, and all of that in context of finance is taught in the first 3 months. The second part of the course teaches you machine learning models and their applications in finance. So all the supervised learning, unsupervised learning, deep learning, neural network, NLP, all of this in context of finance is what is taught in the second 4 months of the course. And in the final part of the course, all students are allowed to choose their area of specialization. So there are four electives offered to all students, and they can choose any one of them: AI for trading, AI for risk management, AI for derivative valuations, and generative AI in finance. So you have four electives to choose from, depending on your interest in what you want to do, right? And what kind of area you want to focus. That is one thing. Second aspect is that this AI for finance course is pretty modular. So if somebody does not want to do the entire course, they can actually pretty much join it like module by module as well, or they can do only part modules, right? So if somebody wants to only focus on the data science part, they can do only the first 3 months of data science for finance. The second, if somebody wants to learn only the machine learning models, they can do the second 4 months, and like they can pretty much do only that, right? And if somebody already have a strong background in data science, machine learning already, right? They can then directly go and choose to join the specialization modules, and you can do multiple specializations as well, right? So you can choose between AI for trading, generative AI in finance, AI for risk management, AI for derivative valuation. So those who have a prior background in data science, machine learning, they can directly go and join the applied modules, right? So these are like, again, short-term modules, actually the applied modules, which are for people who already have knowledge about data science, machine learning, and you want to directly understand the applications in any particular area of finance. I mean, if somebody does not have the background, then of course, they have to learn, and ideally they should then go through the entire AI for finance course, right? Again, it's been a long journey, and then we have had thousands of people who have done our courses, both professionals as well as students, I mean, who have utilized these courses to make very good career in the field of quant, financial engineering, algo trading, machine learning, data science applications. So these are just like examples of maybe small snippets. I mean, anybody interested in understanding how people utilize our course, they can go to our testimonial page. It's not like kind of like, I mean, I want to, it's like, so it's about you to understand how somebody can use these courses to make their careers, right? And what happens is, like, again, I mean, we do when you come to us to do any course, right, or even otherwise, I mean, even before that, right? So we do have a strong placement support system, which starts from when somebody again get in touch with us to discuss about any course, right? So our counseling starts from the beginning itself. I mean, understanding your background, your requirement, and then again helping out with selecting your career, right course, mentoring you in the career path that you can take if you want that or need that, right? And of course, this mentorship is provided by, like, again, all industry experts, and this mentorships again is continued during the course as well, because all the courses are taught by people who are in leadership positions in the industry. So somebody like Ritesh, and there are so many other experts from the industry who comes and teaches in our courses, right? And of course, we do have a dedicated placement support team as well. I mean, once you successfully complete any of our courses, then I mean, the placement support team get in touch with you. I mean, if you're looking for a job, they help you in the entire process, starting from your resume building, interview preparation, helping you with your LinkedIn profiling. And once your profile is ready, they send your resume to relevant companies, particularly for the positions which suits your profile. They actively follow up, get you interview calls, right? So, I mean, being the oldest quant body in India, there's a strong network of connections available to us, through our faculties, through our students for the last 15, 16 years, who themselves, a lot of them are like in very senior positions. So this is like pretty strong, right? And so, yeah, that's like there's a help for everyone who completes the course successfully and then looking for a job. And when I talk about completion, so again, one thing I would like to add is that certificate completion has two aspects, particularly for the long duration courses, right? So you need to complete and submit the capstone project assignments, which are a very integral part of the evaluation. And these assignments are absolutely in conjunction of what you learn in a course. It's an extension of what you learn, right? So, and but these are all industry oriented capstone project assignments which you have to complete and submit. And more than, I mean, apart from that, actually, like again, you would have to also take an MCQ, take an or rather take a MCQ based exam also, which is generally conducted after a gap. Once your lecture series is over for a particular course, then you have to take the exam, clear it. 50% is that I mean, the cutting marks actually for clearing the exam, right? But again, then for all the long duration major courses, the certificate also is jointly awarded now by our institute, Indian Institute of Quantitative Finance, as well as London Institute of Banking Finance. So it's a joint certification, and LIBF, a lot of people may know and a lot of people may not know, it's one of the world's oldest finance certification bodies. It was established in 1876 in UK by King's Charter, right? So they're one of the world's oldest certification bodies, and I mean, more than 1.5 million people have like undergone their courses. So it's like a very well recognized body. So the certificates are jointly awarded with them, and once you get the certificate, you also earn CPD credits also, which are I mean, approved and recognized by international education regulators like OFQUAL. Right now, when one of all of that, so basically a quick glance of the kind of companies generally people would target after doing these courses. They can be targeting hedge funds like Renaissance Technology or DESA or Citadel or Millennium Partners. They can be targeting investment banks like Goldman Sachs, Morgan Stanley, Deutsche Bank. They can be, or the Deutsche Bank. They can be targeting commercial banks like JP Morgan, Citigroup, Nomura. I mean, of course, stock exchanges like NYSE, NSC, with all the big four consulting firms and other consulting firms as well, EY, Deloitte, PwC, to name a few. And of course, the IT companies like, again, all the MNC ones, Accenture, Cognizant, TCS. And then there are a lot of independent analytics companies which can also be targeted, like, for example, Murex or, I mean, Numerics, or I mean, or Uvalusa. I mean, this kind of organizations as well. And then, of course, something that is not added in this is like, I mean, which is a big part of the, I mean, current recruitment are like the fintech organizations, right? Both domestic and international fintech organizations, they hire a lot as well, right? So it's like, again, there's a lot of opportunities out there for people who have trained themselves properly. And I mean, again, I'm not going deep into this, but again, these are some of the profiles which one can target. And of course, these are just an indicative list. There can be a lot of others as well. Again, the very small list of organizations which we have all pretty much worked with the entire uh, uh, quant industry, be it the international banks or the big four consulting trading desks or hedge funds, right? So the industry connect is pretty strong. So, I mean, those are just a small indication. And yes, as a part of our endeavor to promote this field, we regularly work with institutions, educational leading education institutions as well. This is just a small list again. I mean, institutes like IIT Madras, IIT Roorkee, IIT Bombay, BITS Pilani, uh, NITI, which is now I am Mumbai. So we regularly work with leading educational institutions, spreading the uh, I mean, awareness about this field. I've been discussing about various topics because anyway, this is like a quite a hot area. And I mean, say for example, I'm just going to maybe in the February 1st. Me personally is going to IIT Madras again to give a talk on the field of like career opportunities in your financial engineering and quant trading, right? So these are things which we regularly keep on doing. And anybody who gets interested in learning about our field or discussing anything regarding this, about the field or any guidance that you need, I mean, in case you get interested in any of these courses, I mean, please feel free to connect.